Good day. Ira Epstein with your agriculture update, and this review is for Monday, the 16th of December, 2019, 3:36 p.m. Central Time. So here we are with a big gain in the grain market, and this is probably the fallout that has to do with the market now looking forward to corn and wheat purchases at a minimum from China. We know that soybeans have been on the agenda and they're still buying away. There's no choice there. President Trump today did come out and he made a statement that he expects to have the deal completed within 2 weeks. Now, what none of us know are the fine details of it. China's been very mum. Our representatives have said this, Larry Kudlow and Mr. Lighthizer, this is a done deal. So it's now just a matter of going through the deal and putting the pencil to how much is being bought, what is being bought, where we're at, and how you make up this difference, which is going to be the interesting part. The stock market followed through today on the upside. As you can see, dollar down a fraction is a mixed day in the currencies. Now keep in the back of your mind that we're coming now into the last, in fact this is it, this is the last full trading week of 2019. It's hard to believe, but next week we're already into the Christmas period, then the New Year's period, and then away we go right into the new year. In the spirit of that, I've already changed to the March roll, if you will, on the stock indices. Currencies we did last week, and you've start looking at the Jan beans and get away from those, go into the March at this point in time. So when we take a look at the weekly area chart of closes, one of the things in looking back, and I often do that with what I talk about to you, I'm not always right, nobody is, but when we were up here in this 938, 940 zone, we're talking, could the market pull back and maybe get to that 18-week moving average of closes? It certainly went through it, and now you've come back up and you can see that the market has bounced away. I will go on, and did go on record, as saying that I thought the harvest low was made about a week and a half ago when we talked about this on the recent break. Now here's the March beans. This was that low area. And when you put the swing lines on, what got me the most excited was when we crossed this area, because it put into a pattern higher lows, higher highs. You don't really see much of that when you have a chart without the swing lines. When you put it on, you see it. The risk to the chart to break the current uptrend at work would be to get in the March beans back under 902.5. The market has been playing around for, roughly 3-4 days, as you can see, between the 100-day average and the 18. It broke out of that number on Friday, and you had your follow-through to the upside today. And it's good-sized follow-through. It was 14.5 cents. So since you're over the 100-day moving average and the 18, where might resistance show? In my charting course, which many of you did sign up for, we had a phenomenal December of that Cyber Week sale. I look for the upper Bollinger Band to be a resistance. Now, the logical thing you'll say is, Ira, we got there on Friday. And I say, okay. You got there, you backed away about 8 cents by the close. You're back up and over it, but it is a resistance zone. So this is the area where I'm looking for some problems to show up in the market. Wouldn't surprise that the market, surprise me at least, that the market's got to consolidate some of these gains. What would be the afterburner to higher prices? Well, finding out the details on what the U.S.-Chinese trade deal is and get a surprise out of that. The question is, how do you surprise the market? Because China can only import at a certain time so much. They've already said they're not going to overbuy the market. They're seeing our purchases come in. We're seeing South America. And remember, they play one market against the other, as they should. There's nothing wrong with good business. And they're not going to break their new supply chain that they've built up in a year and a half with South America over us that could at any point slap on more tariffs. That doesn't mean you don't do business with the U.S., but you got to use your head about it too. When I look at momentum, I see an overbought market. So when the stochastic study, which is an oscillator of momentum, gets over the 80 level, and I'll come back to this, you got over 70, actually 70 levels, the right number. I want to take that back. The market started getting overbought last Thursday. If you go to the day before, it wasn't. On Friday, you were getting even more overbought. It hit the first upside real resistance area. Now, I don't think that the 100-day acted as a resistance zone. I wish I could say it did, but on this rally, it never quite hit it. It pulled back, and then it slid right through it. On pullbacks, this will surprise me if the 920 area where that's at doesn't act as some support, and that's about 16 cents away. When I come to the meal market, momentum up. The pattern is still one of lower highs but higher lows, and those higher lows were set on Friday. So the market came in, to me at least, out of its downtrend because the pattern changed. Up until then, you still had lower highs, lower lows. We didn't know where this low was going to end up. The market challenged the 18-day average. The first challenge of it was a resistance point. As you can see, it settled under it. And today, with the follow-through from all, the market decided to move forward. And unlike what the beans did, this is when I say that the 100-day average, the first challenge, is acting as the resistance. It is. So the combination between here and the upper Bollinger Band is where I think the pros are going to take money off the table. Should the market clear 306.70 and it hit 305.90 as a high today, that would change the pattern to one of higher lows, higher highs, however, right into the Bollinger Band. So maybe this is an area where now you're getting the Johnny-come-latelys understanding that something has changed in the U.S.-Chinese relationship. The powerhouse of the soy complex is the oil. It is the leader in this market. And as you can see, it's run to the upside. Now, it's a pretty dramatic run from 30.43 to 33.43 in about just over a 2-week period. That's just over 10 trading days. The market has now got today over the upper band. It closed over the upper band on Friday. It closed over that band on Thursday. So we have 3 days in a row. I look at each consecutive day over or under a Bollinger Band, and my rule of thumb is to subtract that from the 5% of the time the market settles above or below the band. In other words, 5% of the time the market will settle over the band. Coming into tomorrow, I give the market a 98% chance of closing back under it. How do I use that? Well, if one is looking to be long, and I'm not saying you should or shouldn't, I am saying that it might be back under that band. Why would I look to be short when I'm over the 18-day average? It's my rule of thumb. I don't. So the only thing I'm looking at are opportunities if, and the word is if, I were looking to be long. In the corn market, is this a real breakout of this sideways action? We won't know till after the fact, but it is the first move, as you can see. You hadn't been over this all the way back until September, October, where you're over it. Now, the 100-day average is above the market, so that's the next resistance point. Where is the market momentum? It is overbought. So we have a market that is trying to break out to the upside. It's had one of the qualifiers, a narrow Bollinger Band, these black bands, going sideways. There's certainly no reason to be short. The question is, does the market offer opportunity to get long? In the wheat market, the wheat sliced through the upper Bollinger Band. Now, it's done that before. And each time it has in the past, it seems to get stuck within a day or two. I don't know that this is going to be a lot different, but what we do know is that the market is aggressive on the wheat market. This was a market in plenty of supply if you went back, and you can't see all these prices back here in the summertime, but it was a crashing market that has suddenly come alive. There's serious worries about soft wheat, what's going to happen, the weather's warming up, what's that going to mean if it gets cold after, but I think it's more international demand. I think it's also the dollar slipping a little bit right here and the market getting a pop in it, and it's over the upper band. Now, is it trending? No. Lower low, higher high. A broad market swath. In the sugar market, the seasonals typically pick up where the market tries to find the bottom from this time frame to the end of the year. Just something that I'm watching. I'm very bothered, though, if I were a bull. You just lost an embedded reading. This is what an embedded reading looks like. It's when the two numbers that make up the slow stochastic are going sideways over 80. And it has to do with 3 days or more. And once it does it, it's often accompanied by a market hitting the band. Sometimes it just sticks to it like glue, and the market runs. Well, suddenly what happened today is you lost that reading. You can get the reading back the next day. You cannot after that. It's got to go through the whole process of rebuilding it. When you lose the reading, it is not uncommon for price to run towards the next below it. When it's a bullish reading and you lose it, the next closest moving average. In this case, the red line, the 18-day average of closes. So I am looking for price in the 18-day average to make a run at each other. Maybe the 18 up, price down. The trend is still up. Higher lows, higher highs. I don't view this as more than a correction in the market, not a change of the major trend. Let me show you a trap for people. For those of you that were watching my video this morning, my morning subscriber video, I had put out looking at this, I said, you know, you lost the embedded reading, and when we opened, the market still hadn't lost. I said, but I hate when you lose it and you're this far away from a high. And I started explaining money risk. Money risk is very important. Sometimes it's a filter on a technical trade. Now, what we had here was an outside day down that lost the embedded reading. And this market has had an embedded reading all this way. It's been a phenomenal bull run. What happened on Friday? You get this pattern. Now, what makes a bear trap? It's getting this reading with an outside day down and then taking out the high of that day. More times than not, you'll hear me say, if you take out that high, it often leads to a challenge of whatever key moving average is above the market or the closest of a Bollinger Band. In this case, to get to that number and take it out, you're already over the Bollinger Band. It's just what happened, and the market got thrown back. Now the market's got to figure what to do next. It did re-embed. Both numbers went back over 80. The day after you lose the reading is when the most risk is, but if it stays lost, more times than not, I look for price and the key moving average to come together. Nothing works all the time, so there's ways you put in stops, and I teach that in the charting course. In the cocoa market, battleground is pretty clear. It's the 18-day average of closes. You came down, finally hit the lower Bollinger Band after a big run where the market had gone from the beginning of November right on up until now. We're at December 16th and back on the, what was that, the 13th or 14th. We got down to that number, went back to the 18-day average. Should the market fail again and not take out today's high and settle under the 18-day average, the trend would be down because you'd have then lower highs and lower lows. You've already got the lower and low. The dilemma is the market's already in oversold territory and nowhere near trying to convert from oversold to embedding. Difficult market, resistance 25.86. Cotton market in an uptrend, very overbought. You can see in the slow stochastic reading here, you're already over the 70. Both numbers are not over 80. They're not even trying to switch from overbought to locking in the trend. Support all the way back at wherever that 18-day average comes in. I think those that were long were coming out on the first challenge, the upper Bollinger Band. Cattle market, still looking bullish, but the first challenge of the upper Bollinger Band, I'm going to pull back one more day. Here we go. This is Thursday's action. Think of what we were just showing in corn, by the way. There's that sideways action. Which way is it going to break out? You tried the downside, couldn't get anywhere. You came up today, and you got thrown back right to that Bollinger Band. What is the trend? Up. Is the market overbought? Yes. Where's support? The 18-day average of closes. Now the question is, does the market become like glue and do anything at that number? My problem is you're not even close to embedding. In the feeder cattle, no different. First challenge of the upper Bollinger Band is often where the market runs into the pros and they're coming out. I think if they're long. Now, why would I think long? Because you're over the 18-day average. So my bias, whatever system they have, I'm filtered into buy mode. That does not mean that the other parts of your technique are in the buy mode. But that's it. So I look at that number as resistance, and as you can see today, you get thrown back to under that number. In the hog market, same thing. You know, we all know that we're hearing China's going to buy hogs. People are rushing at it, but that's still a resistance point. You're certainly not in a downtrend. I question if you're in much of an uptrend. Somewhere between this upper Bollinger Band and the 100-day average is the resistance. Support the 18-day average of closes. You know, I'm in the Board of Trade, which is a fabulous building. If you've never been here, you want to come to Chicago and see it. This was the building in the Batman and all the other shows. It's just phenomenal and gorgeous Art Deco. But it's also a building of pros, trading pros, algorithm pros, you name it, they're here. People from the CBOT have just moved into the building as they're selling that building and they're taking office space. So you walk into the building, there's a certain energy about it, and just because we're all talking trading all day, getting in an elevator, it's all you hear. But as you look, these are the markets that our staff here writes about. They write about it, be it the options market, derivative, hedge, futures, any way you want to go. We're talking about the trade, what's going on in South America, China, and then we're going on with all the different reports here. Something for everyone. And you don't have to get all of them. You sign up when you go to our website, and you can pick the markets you want to get some of this research on to see what the benefits are of being with us for our research. How do you get it? It's pretty simple. Call my staff, they'll set you up. You can go to our website. Under free offers on the bottom right, just click that. You can click here, that'll take it as well. I'm longer than normal today, but there's been so much in the ag to talk about, which is rare, but it was worth doing it. I'm Ira Epstein, you have a good day.